What if I told you that market crashes don't just destroy wealth, they create it? While most traders panic and lose, smart investors know how to turn falling prices into massive gains. Seeing your portfolio in the red is stressful, but here's the thing. Successful investing is about removing emotion from the equation. In this video, I'm going to show you exactly how to profit in a bear market, even when everything seems to be crashing. We're diving deep into 5 proven strategies that can help you not just survive a downturn, but actually come out ahead. So buckle up, smash that like button, and let's get started. Before we jump into specific strategies, we need to talk about the most important factor in bear markets, your mindset. When the market is crashing and everyone around you is panicking, it's easy to get caught up in the fear. You see your portfolio shrinking, you hear horror stories on the news, and suddenly, you're making emotional decisions. They see their investments losing value and they think, I gotta get out before it gets worse. So, they sell at the bottom, locking in their losses and missing out on the eventual recovery. But here's the thing, markets are cyclical. What goes down must come up. Every bear market in history has eventually been followed by a bull market, and the people who make the most money are those who can stay calm and rational during the downturns. Think about it this way, when a store has a massive sale, do you run away screaming? No. You see it as an opportunity to buy the things you want at a discount. The same logic applies to the stock market. A bear market is like a giant sale on amazing companies. Instead of fearing the dip, you need to see it for what it is, a chance to buy low and sell high later on. Instead of panicking, you need to have a plan, stick to your strategy, and trust that the market will eventually recover. Remember, in investing, your biggest enemy is often yourself. Alright, now that we've covered the importance of staying calm and rational, let's talk about some actual strategies you can use to profit in a bear market. And the first one is short selling. Now I know what you might be thinking, short selling sounds risky. And you're not wrong, it can be. But with the right knowledge and risk management, it can also be a powerful tool in your investing arsenal. So, how does short selling work? In simple terms, it's the opposite of buying a stock. When you buy a stock, you're hoping the price goes up, so you can sell it for a profit, right? With short selling, you're doing the reverse. You're betting that the price of a stock is going to go down. You borrow shares of a stock from your broker, then you immediately sell those borrowed shares at the current market price. Then when the price of the stock drops, you buy back those shares at the lower price and return them to your broker, pocketing the difference as your profit. Let's say you're researching a company and you believe their stock is overvalued. You think it's going to drop from $100 per share down to $70 per share. So, you short 100 shares at $100, receiving $10,000. If your prediction is right, and the stock drops to $70, you buy back those 100 shares for $7,000. You return the shares to your broker and boom, you just made a $3,000 profit. However, it's crucial to remember that short selling carries a higher risk than traditional investing. If the stock price goes up instead of down, you'll have to buy it back at a higher price, meaning you could lose more money than you initially invested. That's why it's absolutely critical to set stop-loss orders when short selling. A stop-loss order is an instruction you give your broker to automatically buy back the shares if the price reaches a certain level. Short selling is not something to jump into lightly, but when used correctly, it can be a powerful strategy to profit from declining markets. Now, if the idea of short selling makes you a little uncomfortable, don't worry. There's another strategy for profiting from a bear market that offers a bit more flexibility and potentially less risk buying put options. Think of options like coupons for stocks. They give you the right but not the obligation to buy or sell a stock at a specific price called the strike price, on or before a specific date, the expiration date. There are 2 main types of options, call options and put options. Call options are like bets that a stock price will go up, while put options are bets that a stock price will go down. So, in a bear market, when we're anticipating stock prices to decline, we're interested in put options. When you buy a put option, you're essentially buying the right to sell a stock at a certain price, even if the market price drops below that level. Let's go back to our previous example. You believe that a stock currently trading at $100 is going to drop to $70. Instead of short selling, you could buy a put option with a strike price of $100. This means you have the right to sell the stock at $100, regardless of its market price. Now, if the stock price drops to $70 like you predicted, your put option becomes very valuable. You can buy the stock at $70 in the market and immediately sell it for $100 using your put option, making a tidy $30 profit per share. The great thing about put options is that your potential loss is limited to the premium you paid for the option. Just remember to do your research, understand the risks involved, and consider consulting with a financial advisor before making any investment decisions. So far, we've talked about strategies that directly profit from a decline in stock prices. But what if I told you there's a way to potentially grow your wealth during a bear market without relying on short selling or options? Well, that's where defensive assets come in. Defensive assets are like the reliable, steady Eddie investments of the financial world. They tend to hold their value well, or even increase in value during times of economic uncertainty. Think of them as the safe havens you run to when the market storm clouds start gathering. One classic example of a defensive asset is gold. For centuries, gold has been seen as a store of value, a hedge against inflation, and a safe haven during times of crisis. When the economy takes a downturn and investors get nervous, they often flock to gold, driving up its price. Another popular defensive asset is bonds, particularly U.S. Treasury bonds. These are considered among the safest investments in the world because they're backed by the full faith and credit of the U.S. government. When stock prices are falling, investors often move their money into bonds, seeking stability and a steady stream of income. And don't forget about dividend-paying stocks. While growth stocks tend to take a hit during bear markets, companies with a long history of paying dividends can offer some protection. These are typically well-established companies with strong financials and a commitment to returning profits to shareholders, even during tough times. By diversifying your portfolio with a mix of defensive and growth-oriented assets, you can potentially reduce your overall risk and weather the storm of a bear market more effectively. Remember, even defensive assets are not completely immune to market downturns. Okay, I know what you're thinking. You're telling me to invest during a bear market when everyone else is running for the hills? Hear me out, because this strategy is all about taking advantage of fear and positioning yourself for long-term growth. It's called dollar cost averaging, and it's a powerful tool for navigating volatile markets. Here's the basic idea. Instead of trying to time the market perfectly and invest a lump sum all at once, you invest a fixed amount of money at regular intervals, regardless of the market conditions. This could be monthly, quarterly, or whatever time frame works best for you. When prices are down, you're buying more shares or units of an asset for the same amount of money. This lowers your average cost per share over time, which can significantly boost your returns when the market eventually recovers. Let's say you want to invest in a specific stock, and you have $12,000 to invest over the year. Instead of investing it all at once, you decide to dollar cost average by investing $1,000 on the first of every month. In some months, the market is up, and your $1,000 buys you fewer shares, but in other months when the market is down, your $1,000 buys you more shares. Over time, this strategy averages out the price you pay, potentially reducing your risk and setting you up for greater returns when the market rebounds. The key to successful dollar cost averaging is to focus on high-quality, fundamentally strong assets that you believe in for the long term. Dollar cost averaging helps you stay disciplined, avoid emotional decisions, and take advantage of market volatility to your advantage. So there you have it. 5 proven strategies to not just survive, but thrive in a bear market. Remember, while it's natural to feel anxious when the market is down, it's important to remember that bear markets are a normal part of the economic cycle. By understanding the psychology of bear markets, having a plan, and sticking to your strategy, you can turn these periods of uncertainty into opportunities for growth. Whether it's short selling, buying put options, investing in defensive assets, or dollar cost averaging, there are strategies out there that align with your risk tolerance and financial goals. If you found value in these strategies, make sure to subscribe to this channel. Financial freedom is a journey, and there's always more to learn about navigating markets and building wealth. Thank you for watching, and I'll see you in the next video.